Supermicro Computer Inc., trading under ticker SMCI on the NASDAQ, is currently trading live at $31.78, up an astounding 24.65% or $6.28 per share during today's session, rebounding sharply from its prior close of $25.50. While the headline numbers on financial portals point to a staggering 24% single-day rally following a massive revision in gross margin guidance and a $60 billion order intake announcement, the real story quietly unfolding behind order flow order books reveals a far more complex dynamic. Most market observers believe this massive pop is simply a victory lap for liquid-cooled hardware suppliers riding the coattails of AI server demand. But when you look closely at institutional position sizing across major platforms, you see that sophisticated capital is treating this price movement as a tactical short squeeze rather than an unconditional vote of long-term confidence. Investors logging into their individual brokerage accounts or checking market feeds on the Robinhood app and SoFi Invest app have watched SMCI swing wildly over recent months, swinging between a 52-week low of $19.48 and previous highs. Wall Street consensus expected another period of margin compression given high component costs and inventory buildup, but Supermicro surprised analysts when announcing fourth-quarter fiscal 2026 gross margin estimates of 15% to 17%, nearly double the previous guided range of 8.2% to 8.4%. This immediate discrepancy between market expectations and operational reality sent trading volumes soaring above 98 million shares in morning trading alone, drastically surpassing its average daily volume. For months, retail traders and institutional desks alike held a unified narrative about Supermicro. The prevailing belief was that while the company sat at the center of server rack infrastructure, its lack of pricing power, combined with administrative delays, capital dilution, and supply chain friction, would permanently cap profit margins near single digits. Wall Street treated Supermicro as a low-margin hardware assembler destined to lose ground to corporate heavyweights like Dell Technologies and Hewlett-Packard Enterprise. That belief was challenged in a single market update. By reporting record order bookings exceeding $60 billion for the single quarter, a figure that eclipses their entire annual revenue run rate, Supermicro demonstrated that hyperscale cloud providers and enterprise buyers are actively locking in server capacity for high-density GPU deployments. However, a deeper contrarian analysis shows that this massive surge in backlog comes with significant balance sheet trade-offs that retail investors on self-investing tools might easily overlook. Generating high gross margins on complex liquid-cooled server architectures requires immense upfront capital, working capital lines, and relentless execution without component delays. Looking closely at recent stock price action, SMCI has experienced extreme daily price swings. Prior to today's gap up, the equity had drifted lower through May and June, weighed down by shareholder dilution concerns after the company raised $7 billion through equity offerings and convertible preferred shares to fund inventory expansion. Trading activity on Interactive Brokers trading software and the Fidelity mobile app registered elevated short interest heading into this earnings update, making the stock prime real estate for a sharp short covering rally once the margin news hit the wire. When short sellers were forced to cover their positions alongside buy orders hitting the Fidelity trading platform and Interactive Brokers platform, the upward momentum accelerated rapidly during early session hours. Institutional flow data indicates that quantitative funds and momentum-driven hedge funds drove a large portion of the opening buying pressure, while long-only funds remained somewhat cautious, evaluating whether these margin gains are durable across subsequent quarters or merely the result of favorable component mix pricing in a single 3-month period. Macroeconomic pressures continued to play a major role in shaping trading behavior across the broader technology sector. High benchmark interest rates and tight corporate IT budgets have forced enterprises to reevaluate their capital expenditures, yet enterprise spending on server hardware built specifically for high-performance computing has proven surprisingly resilient. Traders tracking NVIDIA stock, Apple stock and Tesla stock have noticed how tightly server ecosystem equities correlate with GPU shipment schedules. When graphics processing unit suppliers maintain robust shipment cadence, system integrators like Supermicro reap immediate volume gains. However, sector momentum remains vulnerable to supply bottlenecks, foreign exchange fluctuations, and memory chip price spikes. Investors managing portfolios through automated asset tools like Schwab Intelligent Portfolios or a SoFi robo-advisor often see these high-beta technology holdings driving portfolio volatility during earnings season, requiring careful asset allocation and risk management strategies. At its core, Supermicro Computer designs, manufactures, and sells high-performance server and storage solutions built on modular, open architecture technology. Founded in 1993 and headquartered in San Jose, California, the company specializes in liquid cooling systems, rack-scale integration, and energy-efficient server platforms designed for data centers, cloud computing, edge computing, and complex artificial intelligence workloads. Their business model relies on building customized rack-level server configurations that can be deployed rapidly into hyperscale environments, giving them a speed-to-market advantage over legacy hardware vendors. Historical financial statements show rapid revenue scaling over past years, growing from roughly $5 billion in fiscal 2022 to over $14 billion in fiscal 2024 and expanding further in fiscal 2025 and 2026. Yet historically, operating margins have remained tight, historically sitting around 5 to 8% due to fierce competition and high raw material costs, which is precisely why the latest jump in guided gross margins caught the investment community off guard. Comment below how many shares of Supermicro Computer you currently hold, or whether you think hardware server margins can stay above 15% in the coming quarters. Looking ahead toward the future outlook, Supermicro faces a distinct set of potential catalysts and structural risks. On the catalyst side, the accelerating rollout of next-generation GPU platforms and expanding liquid cooling adoption present massive top-line expansion opportunities. As data centers hit thermal limits with traditional air cooling, Supermicro's early investments in direct-to-chip liquid cooling position it as a primary partner for cloud builders needing high-density installations. However, if the company continues to convert its $60 billion order backlog into recognized revenue at 15+% gross margins, consensus earnings estimates across Wall Street will inevitably be revised upward, attracting sustained institutional inflows from Fidelity mutual funds, Fidelity ETFs, and broad market index funds. Online investment research platforms and investment help services are already highlighting this potential earnings upside for active traders searching for growth opportunities on Robinhood stock trading or SoFi active investing platforms. On the risk side of the ledger, execution vulnerabilities remain elevated. Managing a massive order backlog requires flawless inventory control, uninterrupted component supply from key chip manufacturers, and steady capital access. Any supply chain bottleneck, key component shortage, or customer order delay could push revenue recognition into future periods, causing sharp downside volatility in a stock that carries a high beta coefficient. Previous capital raises demonstrate that growth requires substantial balance sheet liquidity, which can result in equity dilution for existing retail shareholders using individual brokerage accounts or Robinhood fractional shares. Competition from rival hardware makers who are aggressively discounting server solutions to gain market share presents another ongoing risk to long-term pricing power. Navigating this environment requires comparing expectations directly against operational reality. The widespread expectation among retail traders using online investing sites or managing a self-investing account was that Supermicro would struggle with margin degradation under the weight of rising component costs and corporate overhead. The reality delivered in their latest update proved that strong order demand and optimized product mix can drive a dramatic short-term profitability surge. However, the longer-term reality will depend entirely on whether management can maintain operational excellence, prevent margin compression, and execute flawlessly on its $60 billion order pipeline without further diluting equity holders. For investors utilizing Fidelity Brokerage, Fidelity Wealth Management, Interactive Brokers account tools, or managing tax-advantaged Fidelity IRAs, maintaining a clear distinction between short-term momentum trading and long-term fundamental valuation remains essential. Supermicro has demonstrated its ability to shock the market to the upside, but sustained investor value will depend on turning today's margin surprise into long-term financial stability.